Hello and welcome to Insurance in Canada. I'm your host, Rick Padeta. Thank you so much for joining me. On today's episode, we're looking at three articles. Our first article looks at some of the challenges when it comes to insuring growers and retailers in the cannabis industry. Our second article looks at Alberta cracking down on commercial trucking enterprises and unsafe practices. And our last article looks at a new tool that the federal regulator has created in order to help alleviate if a property and casualty insurance company goes bankrupt. So without further ado, let's take a look at insurance in the news. Our first article looks at some of the challenges when it comes to insuring at commercial enterprises in the cannabis industry. Of course, in Canada, cannabis has been legal for quite a number of years, and now that it's a legal product, of course, now it's subject to being insurable because illegal practices, illegal products are not insurable through the Canadian insurance market. But now that it is legal, let's look at some of the issues both here in Canada and the United States. This particular article looks at Canada and the United States when it comes to insuring entities in the cannabis industry. So, carrying safes, driving cars through doors, the world of cannabis claims, exposures, and risks. Entire safes being carried out of businesses, vehicles smashing through doors, devastating fires at indoor growing facilities, and toss in the occasional run-of-the-mill bodily injury claim. These are some of the tales from a panel of insurance professionals at Insurance Journal's annual Insuring Cannabis Summit who discuss the market and other pressing claims trends that the legal cannabis insurance industry faces today. Topics include navigating the industry's unique exposures, managing risks that come with operating cash-heavy businesses, and coverage considerations for cannabis lounges. From cultivation to cash registers, the world of cannabis-related claims can present unique challenges. When asked about the biggest exposure she sees in the industry, Beth Osino, claims manager at Golden Bear Insurance Company, brought up theft and robbery. She recalled a couple of instances of devastating losses for insureds, including thieves carrying a safe out of a business and robbers making off with huge amounts of product, which is not surprising because any business industry that deals with very valuable items that's easily portable is always going to be a high theft target. Jewelry stores are a perfect example of this, and cannabis would be no different. It doesn't take a whole lot of space in your vehicle to carry a large amount of product after a robbery, so that is not surprising to hear that theft would be the number one issue when it comes to cannabis businesses. Back to the article, we've had entire crops where maybe the insured harvests 600 plants and the next day there's a box truck that rams through their roll-up door and steals all of the products. She said they come in and they'll take whatever they can get their hands on. Sublimits and specific protective safeguards on policies can make these claims tricky, Osino said. Sometimes policyholders are non-compliant with protective safeguards endorsements, such as wired alarm systems or sprinklers. Record-keeping holes in a dispensary's account can also become sticking points in business interruption claims. So sometimes on commercial policies, you'll have what are called warranties. These are things that the insured usually must do, on very rare cases must not do, but it's usually something that they have to do in order for coverage to apply. The most common one is the alarm warranty, where there must be a monitor burglar alarm system that has to be activated anytime the premises are not open for business in order for theft coverage to apply. So I'm guessing what the Osino is talking about is some of these clients had warranties on their policies that when they were not complying with and jeopardized their coverage when the claim actually happened. Michael Kirk, an underwriter at Cannabis Insurance Services, added his perspective on risk and loss from an underwriting standpoint. LED lights are favorable to non-LED lights in cultivation facilities. Old school growers may prefer the older lights, but bulb fires rank among the top of Cannabis concerns. I really haven't seen any LED fire claims, Kirk said. I'm sure there are claims out there as well, but they are such lower temperature that it makes it a lot less risky when they're using replacing all LED. So from our standpoint at Insurer, if we're insuring a cultivator, they have to be either 100% LED or fully sprinklered. While a mix of lighting types exists today, all cultivators will use LED lights soon, Kirk believes. Michael Denope, cannabis practice leader at World Insurance Associates, also believes LEDs are becoming more prominent. However, while the temperature of these lights is not a great concern, it's the temperature of their power sources that can cause issues. They do get quite hot. The nose said if you go into a room that's been in the vegetative state and those lights have been on for 10 to 12 hours, those drivers are really hot. The lights themselves are not, but the drivers are. Over the past year or so, he and his team has seen lighting companies offer driverless systems and remote driver systems excuse me, that situate the LED light-powered drivers outside of grow rooms, completing and removing the risk of lights, heats, profiles, and placing less strain on ventilation system. Kirk also touched on individually ventilated grow rooms, which can minimize plant losses due to fires. Smoke that damages crops between rooms can lead to a huge claim, he said. Legal cannabis businesses can make big targets for criminals because of the large amounts of cash they hold as cash-heavy operations, since banking is highly regulated by the federal government. And talk about the U.S. federal government, but that also applies here in Canada as well. Many banks don't provide any services to the cannabis industry. Once again, I believe that's more down in the States, banks in the States, than it would be in Canada. Osino discussed a large insured in Oakland, California that would rent an armored truck quarterly to take their tax payments across the Bay Bridge to the San Francisco Mint. Changes to this aspect of the cannabis businesses could come soon. In late July, a bipartisan coalition of 32 attorneys generals called on Congress to pass the Safer Banking Act of 2025, designed to shield banks, credit unions, insurers, and other financial service providers from liability for providing traditional business services to state-sanctioned cannabis companies. So legalized cannabis is something that's a bit more newer in the States than it is for us in Canada. So industries here, whether it's financial services or others, are a little more used to dealing with the cannabis industry. Deneau said his clients have experienced minimal claims involving crime and theft. That's kind of surprising, but okay. He and Kirk did note, however, that they are prevalent in the cannabis business. Kirk said some methods to slow or deter crime, including investing in vault quality and placing bollards outside entrances. The latter also prevents property damage. Deneau touched on the importance of risk management, including armored car and security services, and installing different locks and keypads on access point to secure storage of cash and products. His team at World Insurance Associates have a designated risk management division that identifies where businesses can improve their risks and helps them to do so. That's always an important service when it comes to large brokerages or some insurers that will offer that risk management service to their clients. It's a win-win situation for both the insurance company and the client to engage in these services to identify deficiencies and also potential sources of loss that the owner may not have realized or may not be aware of. It helps the insurance company by avoiding claims, and also helps the business as well, because, you know, the business wants to stay in business. They don't want to have to deal with trying to recover from a loss, whether it's a minor loss or a major loss. Any disruption in business is bad for business. What can you say? Cannabis lounges that serve food add another dimension to property underwriting, Kirk explained, because they present restaurant-type exposures. Do they host live music events? What level of security is on hand? Insurer has a questionnaire it runs through with potential brokers and insureds. From a carrier standpoint, we ask more questions. He said, what are the hours of the operation? What kind of safeguards do you have in place? For somebody who looks intoxicated as a bud tender, not bartender, bud tender, or whoever serving them, are they trained to recognize somebody like that? I don't think I've ever seen a cannabis lounge here in Ontario. I don't go looking for them, so that might be one of the reasons why. But like I said, I'm not sure if that's something that exists, is allowed here in Ontario. or if it's allowed anywhere else in Canada. If your particular province or territory allows this, please let us know down in the comments section. But it's interesting because I don't even know if there is such a, because there is for bars and restaurants that serve alcohol. Ontario has the Smart Serve program. Other provinces have their own version of a training program for people who serve alcohol to the public. What they're supposed to be doing, what they're supposed to be looking for in terms of intoxication, when they're supposed to be stopping such a serving alcohol. But I don't know if such an equivalent exists for cannabis. So, like I said, because maybe lounges that don't exist aren't allowed here in Ontario, maybe that's because they don't exist. But if that ever occurs in Ontario, or if it actually exists in other places, that could be an interesting occupation to get into, to develop uh, your own version of Smart Serve for the cannabis lounge industry. On to our next article, we look at Alberta cracking down on unsafe, reckless commercial trucking practices. Rather important step to be taken, because we talked about in previous episodes how certain provinces are cracking down on the tow truck industry. I think commercial trucking is an even more urgent state of needing to have the unsafe drivers be pulled off the road as soon as possible, because I see in my feed on Twitter/X reports from various police agencies about accidents occurring on provincial and territorial roads involving accidents involving commercial trucks, tractor trailers. Sometimes it's single vehicles, sometimes it involves other vehicles, but because of the size of these vehicles, it's critical that provincial governments and territorial governments get a handle on some of the deficiencies that seems to be popping up more and more when it comes to drivers and their vehicles. So let's take a look what Alberta is doing. The Alberta government on Friday announced sweeping changes aimed at cracking down on what it said are unsafe commercial driving training schools and bad actors in the trucking industry. The province said the ramped up enforcement includes more oversight of driver training schools and carriers through inspections, audits, and targeted investigations. The transportation minister said the province is going after reckless operators who ignore the rules. Anyone cutting corners or operating unsafe trucks will be removed from our roads. Transportation Minister Devin Dreeshen said in a statement, Alberta truckers have earned a reputation as some of the most trusted drivers in the country, and we will not allow a few bad actors to undermine that trust. So far, the province said it has ordered the closure of 5 driver training schools. In addition, the province said it has issued 39 disciplinary letters, more than 100,000 in administrative penalties, 6 corrective action plans, revoked 12 instructor licenses, and sent 4 warning letters to driver examiners. The province said it's also targeting a misclassified driver scheme known as Drivers Inc., where companies hire drivers as independent contractors to avoid payroll taxes and benefits. The drivers often lack proper training and oversight and are vulnerable to exploitation. And don't think that this same scheme doesn't exist in other provinces. Back in July, a week-long commercial driver status and classification check stop was conducted in which 195 drivers were stopped. Of those, 20% of the drivers were suspected of being misclassified, including several temporary foreign workers. 13 commercial trucking companies have also been removed from Alberta's roads due to poor on-road performance, unsafe equipment, or failure to meet mandatory safety standards. Of those, the provinces said 7 were identified as chameleon carriers, companies that try to avoid regulatory oversight by changing names, creating new entities, or relocating operations across jurisdictions. Put those people in jail. Seriously, just straight to jail. The Alberta government is not, commercial trucking is not something you want to mess around with. Play games? No. Play stupid games, win stupid prizes. Get their butts in jail. The Alberta government said it's working with federal and provincial territorial partners to strengthen enforcement Canada-wide to address chameleon carriers. Work is also underway by the Canadian Council of Motor Transport Administrators to develop a national database to address the loophole that carriers currently use to exploit gaps in interprovincial data sharing and enforcement. The council said it would eventually like to see commercial trucking treated like other trades, elevating driver training standards to align with the established benchmarks of a designated trade, with the ultimate goal of achieving Red Seal designation for the transportation industry, represents a significant and positive step forward, said Don McDonald, Operations Manager for CCA Truck Driver Training Limited, and interim chairman of the Professional Truck Training Alliance of Canada. He said the initiative will contribute to safer roads and increase professionalism and integrity across all sectors of the industry. Friday's announcement comes 6 months after the province introduced new training requirements. On April 1st, the province launched a Class 1 learning pathway that requires 125 to 133 in-truck training hours, which the province said is well above the national mandatory entry-level training minimum. The program has stricter licensing requirements for driver training schools, mandatory safety equipment standards, and greater monitoring of instructors. By late 2025, the Alberta government said driver experience records will follow the driver, not the company, improving transparency for hiring and insurance. The province said commercial driver training schools, instructors, and examiners found to be breaking safety regulations are issued remedial actions such as directives to correct non-compliance, re-education, administrative penalties, and disciplinary actions, including suspensions or cancellation of their license. So I would think that the trucking industry, at the very least, such organizations as the Professional Truck Training Alliance of Canada, welcomes these measures and welcomes these crackdowns being imposed, not just by the Alberta government. I know here in Ontario, I think it was last month, or maybe it was back in August, the regulators discovered a scam involving people going for tests where they don't understand English and were being fed through a wireless earpiece. The answers, they would usually wear a small camera on their chest, so whoever was coaching them could see the screen so they can coach the correct answer. And I believe the provincial regulator in Ontario sent out about 1,200 letters announcing to these people that they were getting their licenses revoked for suspected cheating. So, like I said, good to see that these provinces are cracking down, and I'm sure the trucking industry, the good players, are also welcoming this as well, because insurance for these types of vehicles, it is expensive, and with continuous losses due to unsafe vehicles, unsafe drivers, it's only going to get worse for the trucking industry, make it worse for the good operators who at one point may not be able to afford the insurance because it just keeps climbing and climbing because of all the actions of the bad actors. So a welcome action in my belief, and hopefully we'll see further action being taken by other jurisdictions as well. Our last article looks at a measure being introduced by the the Office of the Superintendent of Financial Institutions, allowing the Property and Casualty Insurance Compensation Corporation to create a new entity to help resolve any issues when it comes to an insurance company going bankrupt. Now, in Canada, you don't see too many insurance companies going bankrupt. The last insurance company to go bankrupt in Canada was back in 2012, the Union of Canada Life Insurance Company. The last property and casualty insurance company to go bankrupt was the Home Insurance Company, and that was back in 2003. So it's been 22 years since the last property and casualty insurance company went bust. So, like I said, it's not something you see too often, but there is an organization called the Property and Casualty Insurance Compensation Corporation, the PACICC, and they exist in order to deal with an insurance company that is a property and casualty insurance company that is going bankrupt to ensure the policyholders remain protected until the insurance company is wound down and the policyholders for that insurance company have had a chance to seek coverage elsewhere. There is an equivalent on the life and accident sickness side. There's an organization called Assurus who does the same thing, but that's for life insurance companies and accident and sickness insurance companies. So let's take a look at this article. Fed's greenlight PACICC's request to establish a bridge insurer to resolve insolvencies. Canada's federal government has added to the toolkit to help Property and Casualty Insurance Compensation Corporation, PACICC, protect consumers from the impact of an insurance company insolvency. The Minister of Finance and National Revenue has authorized PACICC to establish a bridge insurer to be known as PACICC-SIMA General Insurance Company, or PGIC. Can't make these names any longer. The federal government signed the Bridge Insurer's Patent of Incorporation in July. This was a significant milestone for PACICC as it delivered on an idea dating back to 2020 industry consultations when insurance company members expressed preliminary interest in the idea of an OSFI. That's the Office of the Superintendent of Financial Institutions. So every province has their own regulatory body for insurance companies. The OSFI is the federal government equivalent. So if you have an insurance company that wants to just do business in Alberta, they would register with the Alberta, I don't know what the Alberta version of their regulatory body is called. In Ontario, it's FSRA, Financial Services Regulatory Authority of Ontario. So the OSFI is the federal government version. So if an insurance company wants to operate across many provinces, normally they would register with the OSFI and be subject to their regulations. They still have to comply with the provincial regulations as well, but once the insurance company registers with OSFI, it's a lot easier to get approval from the provincial insurer. So that's why the OSFI exists. The plan is for PGIC to lay dormant as a shell entity until needed. Any decision to activate PGIC will require a consensus decision of PACICC's Board of Directors, the Office of the Superintendent of Financial Institutions, and the relevant provincial regulators. A set of threshold criteria must be met for both PACICC and the Federal Solvency Regulator to agree to involve the bridge insurer. PACICC approved starting the application process to form a bridge insurer in 2023, noting a similar bridge insurer company exists on the life insurance side. Assurus, a sister compensation fund for the life insurance side, has a shell bridge insurer, CompCorp Life Insurance Company. CompCorp was involved in the winding up a sovereign life insurance company in 1993. PACICC notes the International Association of Insurance Supervisors recommends that a bridge insurer be part of any effective insurance solvency resolution framework. PACICC is closely monitoring the role of a bridge insurer in an ongoing situation in South Korea. There, a bridge insurer is acting as a buffer for consumers as the troubled company is shopped around to potential buyers. Recently, an interesting case has been playing out in South Korea involving the country's 10th largest non-life insurer, MG Non-Life Insurance Company. On April 13th, 2022, MG was declared as an insolvent financial institution by its regulator, the Financial Services Commission. This was the first time in 8 years the FSC has labeled a financial institution as insolvent. So I've never seen it actually, this bridge insurer spring into action. So I imagine they would, if it's required to be activated, the bridge insurer would take over the running of the company, either to try and find a buyer, although I imagine if the insurance company was starting to fail, they'd be looking for another insurance company to buy them out. So trying to find it after the insurance company has gone bankrupt might be a little more difficult, but I imagine the bridge insurer would actually kick in to take over the assets of that company until it's wound down. Uh, at the end of 2021, the MG non-life insurance companies, its risk-based capital adequacy, a key measure of its financial institution, was at 88.3%, less than 100% standard set by the Insurance Business Act under Korean law. An insolvent financial institution such as MG is obliged to find a new owner, but 4 public sale attempts have been made since April 2022, and they all failed. Meanwhile, MG's financial condition has continued to deteriorate. Its debt now totals 1 trillion won, or 733.8 million US by the end of 2025 Q1. Its capital adequacy ratio has fallen to minus 18.2%. In Q1 2025, MG held approximately 1.51 million insurance contracts, with 90% consisting of long-term policies, such as health and accident insurance. Affected policyholders include 1.24 million individual clients and 10,000 corporate accounts. Korea's FSC announced in May 2025 the MG policy contracts will be transferred to 5 major non-life insurance companies, including Samsung Fire and Marine Insurance. Boy, Samsung's got their fingers in everything. Merit's Fine and Marine Insurance, KB Insurance, Hyundai's Marine Insurance, and DB Insurance. A transfer will be done through a bridge insurance company. The Korean government's objective is to pursue a sale of the company at the same time as the transfer of policies to the 5 other insurers. The transfer of policy is expected to be completed by the end of 2026 Q4. Meanwhile, a buyer is being sought by 2026 Q2. If a buyer isn't found, the transfers of policies will proceed. So, an example of why they're going with this idea, why the PACICC is going with this idea. It seems that having this bridge insurer does exist in order to expedite the process of trying to protect the policyholders, ensure claims are still being paid out, while still trying to find someone to carry out either coverage under the policies, under their taking ownership of those policies, or just trying to find somebody who's going to take over the operations of that particular insurance company. But hopefully with the addition of this bridge insurers, it would ensure that the taking over of the insurance company that's faltering will be done as quickly as possible so that policyholders are protected. So that is it for me for today. I'd like to thank you for joining me. If you like what I do here, please like this video. Please subscribe for more, and make sure you follow Insurance in Canada on X/Twitter. So until next time, bye-bye.